Okay, so, we always like to dig into some interesting stuff here on the deep dive. And you've sent over a really, really interesting article this time. It's
Yeah.
called Tech Stock Correction, 5 Lessons from Market Turbulence 2025. And
Huh.
it was published on April 1st, 2025. So
Mm.
very, very recent. And I think for this deep dive, we're gonna take this article as a jumping off point to really try to understand,
Right.
tech stock corrections in general, why they happen, how to spot them,
Mm.
and most importantly, like how to navigate them effectively.
That was it.
Obviously, we're not, we can't predict the future, but this article gives us so much to work with
Yeah.
in terms of just understanding, like the dynamics at play and how these things tend to unfold.
For
So,
sure, for sure.
Hmm.
I think what's really cool about this piece is that it goes beyond like just recounting the events of, what happened in
Yeah.
2025,
Right.
and it really tries to distill some like
Yeah.
timeless, almost like principles,
Mhm.
from that specific period of, market turmoil.
Yeah. Timeless is a great word for it because I think what struck me was that
Yeah,
a lot of these lessons are things that we've seen play out time and time again,
for sure.
right? And then that's kind of what makes them so valuable.
Exactly. And that's what makes it so compelling for us to dissect, because it allows us to think critically about those,
Right.
those fundamental drivers of market behavior,
Mhm.
beyond just the headlines of, tech stock correction 2025.
Yeah, and speaking of headlines, like right out of the gate,
Yeah.
the article defines like what a tech stock correction is, and they basically say it's like a 10% to 20% decline from a recent peak,
Mhm.
and they even point to like March 18th of that year as a potential like high point.
Right.
Um, but what I thought was interesting was they frame these corrections as like a normal part of the market cycle.
Yeah. A healthy, even, a
Yeah,
healthy kind of reset.
exactly. It's not like the sky is falling kind of
Yeah.
situation. It's more like, okay, the market's just kind of like taking a breather.
Yeah. And I think that's a really important perspective to have,
Yeah.
because, it's easy to get caught up in, the fear and the panic
Oh, absolutely.
when the market starts to go down.
Yeah.
But if you can remember that these corrections are normal,
Right.
they're part of the cycle,
Right.
it can help you to stay calm
Yeah.
and make more rational decisions.
And that's really, it's almost like a theme that runs through the whole article. It's like
Yeah,
keeping a cool head
absolutely.
when things get a little rocky.
Emotional fortitude is key.
Yeah, exactly. Exactly. And the other thing that stood out to me is that, this correction in 2025,
Yeah.
it wasn't just like a US thing, right? Like the article talks about
Yeah.
the Hang Seng Tech Index,
Right.
which is like a major index for Chinese tech companies.
Exactly.
Yeah.
Yeah. So it tracks the
Yeah.
performance of like the biggest
Yeah.
tech companies listed in Hong Kong.
Right. And they were seeing very similar trends to what was happening here in the US.
Yeah. Yeah. It really shows how interconnected the global tech landscape has become, right?
Absolutely.
What happens in one market definitely affects
Yeah.
other markets around the world.
So it's a global phenomenon. This is not just like an isolated incident.
Exactly. Exactly.
So let's kind of dig into the why now.
Okay. Yeah. Let's get into the nitty gritty.
Like why are tech stocks in particular
Right.
so susceptible to these kinds of corrections?
Right.
And the article lays out several factors, and the first one that really jumped out at me was just like those sky high growth expectations,
Right.
when you've got these companies in, cutting edge fields like AI and all these other disruptive technologies, like
Yeah.
their valuations are often based on like huge future potential, right?
Right. The expectation that they're going to just
Yeah.
continue to grow at an incredible pace.
Right. And so if that optimism cools even a little bit, or,
Yeah.
those projections get, revised even slightly downward,
Yeah.
things can get pretty volatile.
Yeah. And that's exactly what the article points out, that,
Right.
it's the forward-looking nature of these valuations that makes them so vulnerable,
Right.
right? They're priced for perfection in a way.
Yeah.
And any perceived setback
Right.
can really shake things up.
And, I think a good example of that they mentioned is like the AI adoption curve, right? Like the long-term potential of AI is massive.
Oh, absolutely.
But the short-term path to getting there is
Right.
full of like unknowns.
But it's unpredictable, right?
Yeah.
And that unpredictability breeds volatility.
Exactly. Exactly. So that's one factor.
Yeah.
Another big one that they talk about is sensitivity to interest rate changes, right? A lot of tech companies, especially, those that are growing really rapidly,
Yeah.
They rely on borrowing to finance that growth.
Right. They need capital to expand,
Right,
to
exactly.
develop new products, to hire talent.
And their stock prices are very much tied to,
Yeah,
future earnings.
absolutely. Because investors are betting on
Yeah.
that future growth potential.
So when interest rates go up,
Yeah.
borrowing becomes more expensive.
Right.
And those future profits that everybody's so excited about, they suddenly look a little less appealing.
Exactly. And it's not just that borrowing becomes more expensive for the companies themselves,
Right.
but higher interest rates also make
Yeah.
other investments, like bonds, for example,
Right.
more attractive.
Right.
So investors might start to shift their money
Right.
away from riskier assets like tech stocks.
Into those safer havens.
Exactly, yeah.
So it's like a double whammy.
Absolutely a double whammy.
Okay, so we've got, those high growth expectations.
Yeah.
We've got the sensitivity to interest rates. And then another really important factor they highlight is concentration risk.
Right.
And they use the NASDAQ composite as like a prime example, right? The NASDAQ is heavily weighted towards just a handful of, mega cap companies.
Really players, right?
Yeah, exactly. The names that, everybody knows, like,
Well,
NVIDIA,
yeah.
Apple, Microsoft, like those kinds of.
Absolutely, those household names.
Yeah. So if even just one or two of these giants,
Yeah.
stumble a little bit,
Right.
it can drag down the entire index.
It's like a domino effect, right?
Yeah,
One of those big players sneezes and the whole market catches a cold.
exactly. And it really highlights, like, even if you think you're diversified,
Yeah.
if you're heavily invested in an index like the NASDAQ, you might not be as diversified as you think.
Right, because even within that index,
Yeah.
there's a lot of concentration risk.
Exactly. Okay, so then,
Yeah.
the article kind of zooms out a little bit and starts talking about, geopolitics and regulatory
And it's
development.
bigger picture stuff, right?
Yeah, exactly. And they mention things like, global supply chains, exposure to international sales, data, privacy regulations,
Yeah.
antitrust concerns, like all these things that can kind of create
Yeah.
headwinds for tech companies.
Yeah, it's like a whole other layer of complexity.
Yeah.
Right, because these factors can change so quickly.
Oh, absolutely.
And they can have a huge impact on a company's bottom line.
Right. And they even specifically call out tariffs.
Yeah.
And they even reference, President Trump's policies from, years back.
Right.
And how, like, future tariffs, could potentially impact trade with, countries like Canada, Mexico, China.
Yeah, and that's a really important point because, tariffs can directly affect a company's costs
Right.
and its ability to sell its products in certain markets.
So it's definitely something that investors need to be aware of.
Absolutely. You have to factor that into your risk assessment.
And then the last factor they talk about is kind of interesting because it's like,
Yeah.
it's the rapid pace of innovation in the tech sector.
Right, which is usually seen as a good thing, right?
Yeah, exactly. Like, it's what drives the growth.
Yeah.
But it also means that companies are under constant pressure to, like,
Right, to adapt and to keep up.
yeah, to adapt and to evolve and to, like, not become obsolete, basically.
Yeah, because what's cutting edge today could be outdated tomorrow,
Exactly.
especially in the tech world.
And they use the AI ecosystem as an example.
Right, like AI is moving so fast,
Yeah.
and companies that can't keep up are going to be left behind.
And investors know that.
Oh, yeah.
And that's why it creates, like, this
Right.
volatility.
Yeah, because they're trying to anticipate
Yeah.
who are going to be the winners and losers.
Right, exactly. Okay, so that's a really good overview, I think, of
Yeah.
kind of like the factors that can make tech stocks,
Right.
particularly prone to these kinds of corrections.
It's a complex landscape, right?
Yeah, it is. It's very complex.
With a lot of moving parts.
But now the article kind of shifts gears and it's like,
Yeah.
okay, so we've talked about the why now. Let's talk about, like, what are the lessons we can learn from this?
The actionable insights.
Exactly. And they lay out 5 key lessons, and I think they're all really, really valuable.
Yeah, they're really insightful.
So the first one is all about, like, the power of perspective
Hmm.
and adopting, like, a long-term view.
Right. Playing the long game.
Exactly. And they specifically say, like, for investors, this means, like,
Yeah.
resisting the urge to panic sell during a downturn.
Yeah.
Right?
Which is easier said than done sometimes.
Oh, it's so hard. It's so
Right. When you see your portfolio dropping,
Yeah.
it's natural to want to just like
Yeah.
get out. get out now.
Cut your losses.
But that's often the worst thing you can do.
Right.
Because you're selling at the bottom.
Exactly. You're locking in those losses.
Right. And you might miss out on the rebound.
Yeah. And they even quote Mark Cuban in the article.
Oh, really?
They say, Mark Cuban emphasizes conviction, like believing in your investments.
Right.
And sticking with them through thick and thin.
Yeah. If you've done your research.
And you believe in the long-term potential of a company.
Yeah.
Then you shouldn't let short-term market fluctuations shake your confidence.
And then the article also talks about, for those who are in the C-suite, leading tech companies through these times,
right.
They talk about the importance of providing steady and reassuring leadership.
Yeah.
Right?
Staying calm under pressure.
Exactly. Projecting that confidence.
Right. And communicating clearly with all your stakeholders.
Yeah, your investors, your employees, your customers.
Keeping everyone informed.
Right. And basically just reiterating the company's long-term vision.
Sticking to the plan.
Yeah, and saying look, we're not going to let these short-term fluctuations in the stock price derail our long-term goals.
Exactly, because those long-term investments are crucial. Right?
Absolutely.
Whether it's in AI infrastructure or research and development.
Yeah, so lesson number 1 is all about that long-term perspective.
Yeah. Not getting caught up in the short-term noise.
Right, staying focused on the big picture.
Exactly. Okay, so lesson number 2 is all about strategic portfolio rebalancing. And I think this is a really, really important one.
It's crucial, yeah.
So basically, rebalancing is just the process of buying or selling assets to maintain your desired asset allocation.
To keep your portfolio in balance.
Exactly right. And the article stresses that this is especially important during a correction.
Absolutely, yeah.
So why is that?
Well, for a couple reasons.
Okay.
First, it's a risk management tool.
Okay.
If one asset class, like tech stocks, for example, has been doing really well, it might start to make up a larger portion of your portfolio than you originally intended.
Right. You might be overexposed.
Exactly. And that increases your risk.
Okay.
So rebalancing helps you to trim those oversized positions.
Yeah.
And bring your portfolio back into alignment with your risk tolerance.
So you're basically taking some profits off the table from the winners and reinvesting them in other areas that might be lagging a bit.
And that brings us to the second reason why rebalancing is so important during a correction.
Okay.
It forces you to buy low when tech stocks are down.
Right.
That's the perfect time to buy more shares at a discount.
So it's like a disciplined approach to, buying low, selling high.
Exactly. It takes the emotion out of it.
I like that.
And it helps you to stick to your long-term strategy.
And they talk about 2 main methods for rebalancing.
Right.
Like calendar rebalancing, which is basically just doing it on a set schedule.
Right. Like every quarter or every year.
Right. And then there's threshold rebalancing, where you only adjust when an asset class deviates from its target allocation by a certain percentage.
Right. So let's say your target for tech stocks is 20% of your portfolio.
Yeah.
But after a big run-up, they now make up 30%.
Yeah.
That would trigger rebalancing. You would sell some of your tech holdings and buy other assets to bring your tech allocation back down to 20%.
And the article says that threshold rebalancing is often preferred during those more volatile periods.
Right, because it's more responsive to market changes.
Exactly. And then there's this really interesting point they bring up that I thought you might find particularly interesting.
Okay.
They talk about securities-based lending, or SBL, and how this can be a tool for, high net worth individuals and sophisticated investors to access liquidity during a correction without having to sell their securities at those depressed prices.
Yeah, so instead of selling your stocks at a loss, you can use them as collateral for a loan. And then use that loan to buy other assets.
Oh, that's interesting.
Right. So you can still take advantage of those buying opportunities without having to sell your existing holdings at a low point.
That's a really smart strategy.
It can be. Yeah, if you have the right financial advisor.
Right, exactly. Okay, so moving on to lesson number 3. This one is all about quality over hype. And the point they make is that market corrections can often reveal the underlying weaknesses of companies.
Right, like the tide goes out and you see who's swimming naked.
Exactly. Yeah. Exactly. So it becomes even more important during these times to really focus on those fundamental strengths.
Right, the things that really matter in the long run.
So what are those?
Well, they talk about things like, strong balance sheets with ample cash reserves and manageable debt.
Okay.
They also talk about consistent profitability.
Yeah.
And strong cash flow generation.
So basically, like, are they actually making money?
Exactly right.
Yeah.
And are they generating enough cash to fund their operations and their growth?
Got it.
They also emphasize the importance of a durable competitive advantage,
Right.
often referred to as a moat.
I like
So this could be something like, strong brand loyalty,
Yeah.
network effects, proprietary technology,
Okay.
or a dominant market share.
So basically something that makes it really hard for competitors to, like...
Exactly, to just come in and steal their business.
Right.
And finally, they talk about the importance of a capable and experienced management team.
Yeah, the people at the helm.
Exactly right.
And they say it's crucial to look beyond the hype, even if it's something as exciting as AI, and to really scrutinize those fundamentals.
Right, because not every company that claims to be an AI leader is actually going to be a winner.
Exactly, and that's why that due diligence is so important.
Absolutely. You have to do your homework.
Yeah. Okay, so lesson number 4 is strategic opportunism. And I think this one is really interesting because it's basically saying, like, okay, corrections can create buying opportunities.
Right.
But you got to be smart about it.
Exactly. Yeah. It's not just about buying everything that's down.
Right. You got to be strategic.
Right.
So what does that look like?
Well, the article suggests identifying companies that are fundamentally sound, but whose stock prices have been unfairly punished due to the broader market downturn.
So not because of, like, company-specific problems?
Exactly right.
Yeah.
Like, the company itself is still strong, but the market is just down on the whole sector.
Got it.
And they also suggest using a strategy of scaling in, which means buying in tranches rather than all at once.
So kind of like averaging in over time?
Exactly.
Yeah, that makes sense.
And, of course, patience is key.
Right.
Market recoveries can take time.
So you got to be willing to, like, ride it out.
Absolutely.
Okay, and then finally, lesson number 5 is diversification.
Yes. The golden rule of investing.
And it's something that we talk about a lot, but I think this article really highlights just how important it is, especially during a tech stock correction.
Absolutely. Because if your portfolio is too concentrated in tech stocks, you're going to feel that pain a lot more.
So they talk about diversifying across sectors.
Right. So not just tech, but also things like healthcare, financials, consumer staples.
Okay.
Sectors that might perform differently than the tech sector.
And they also talk about diversifying across asset classes.
Right. So not just stocks. But also bonds.
Okay.
Real estate. Maybe even commodities or alternative investments.
So basically, like, not putting all your eggs in one basket.
Exactly right.
And then they also talk about geographical diversification, investing in different parts of the world.
Yeah, so not just the U.S., but also Europe.
Yeah.
Emerging markets.
And they even mention the Hang Seng Tech Index again here as an example of how, international markets can be affected by these corrections.
Exactly. And it's important to remember that different regions of the world have different economic cycles.
Right.
And they're also affected by different geopolitical events.
So it's not just about, like, picking stocks.
Right.
It's about understanding the global landscape.
Exactly.
Okay. So those are the 5 key lessons for investors. But the article also includes this really cool section called the C-Suite Playbook.
Oh, yeah. I love that section.
Yeah. And it's basically like a guide for leaders at tech companies.
Right. On how to navigate a downturn.
Exactly. So what are some of the key takeaways there?
Well, first and foremost, they emphasize the importance of reinforcing financial discipline. Taking a hard look at budgets, managing cash flow carefully, prioritizing investments that have a clear ROI, and maybe even delaying some non-essential spending.
So basically, like, tightening the belt a little bit.
Exactly right.
Yeah.
It's about being prudent and making sure that your company is in a strong financial position.
To weather the storm.
Exactly.
They also talk about the importance of proactive and transparent communication.
Right.
Keeping those lines of communication open with investors, analysts, employees, customer.
Everyone.
Yeah. And being upfront about the challenges, addressing concerns head on, and just, like, constantly reiterating the company's long-term strategy.
Right. Because in times of uncertainty, people need reassurance.
They need to know that you have a plan.
Exactly. And that you're still confident in the future.
And then they talk about focusing on core operations.
Right.
Like doubling down on what the company does best.
Yeah, whether it's product development, customer service, operational efficiency, whatever it is, that gives them a competitive edge.
And they even suggest that market downturns can create opportunities to gain market share.
Right, because if your competitors are struggling, and you're in a strong position, you might be able to capitalize on that.
That's interesting. It's almost like a counterintuitive way of thinking about it.
It is, but it makes sense, right?
Yeah.
It's about being opportunistic.
And they also talk about evaluating strategic opportunities, like mergers and acquisitions or even talent acquisitions.
Right, because valuations might be more attractive during a downturn.
Right, so it might be a good time to make some strategic moves.
Right, if you have the resources to do so.
And then finally, they talk about leveraging AI within the finance function itself.
Right.
Using it for things like enhanced forecasting, risk assessment, market sentiment analysis.
Okay.
And even driving internal efficiencies.
So basically using technology to help navigate the downturn.
Exactly.
Very meta.
Yeah, so, I mean, this article is just packed with insights.
It's a great resource.
It really is. So for you as an investor, the key takeaways are to maintain that long-term perspective.
Right.
Rebalance your portfolio diligently. Prioritize quality companies. Be strategic about your buying opportunities. And diversify.
Couldn't have said it better myself.
And then for those leading tech companies, the message is clear. You know, reinforce that financial discipline. Communicate openly and honestly with all your stakeholders.
Right.
Focus on what you do best. And be ready to seize those strategic opportunities.
And don't forget about the power of AI.
Exactly.
Yeah. And the article ends on a really powerful note. It reminds us that tech stock corrections are inevitable. They're part of the cycle. But they also present opportunities for those who are prepared.
So it's not all doom and gloom.
No, not at all.
It's just about being smart.
Exactly.
And being prepared.
Yeah.
So here's a final thought for you.
Okay.
Given that, you know, markets are cyclical.
Right.
And technology is always evolving. How do you think these lessons from the 2025 correction can inform your approach to future market shifts?
That's a great question.
And I'm not just talking about tech. I'm talking about your overall investment strategy. Your business decisions.
It really makes you think about how to balance that long-term vision with the need to be adaptable in the short term. It's a constant challenge.
It is, but it's a challenge that we have to embrace.
Absolutely.
Because the only constant is change.
That's the truth.
And if we can learn to navigate that change effectively, we can not only survive, but thrive.
I completely agree.